In this episode, we're going to address the basic tax concepts of tax deductions and tax credits. Generally speaking, tax deductions apply against and reduce your taxable income, whereas tax credits apply against and reduce your tax due. To make sense of this, we're going to review a simple example. Starting with tax deductions, remember that tax deductions reduce the amount of taxable income. So let's assume that you are starting with taxable income of $50,000 and assume an ordinary income tax rate of 20%. And note that this is just an example. I'm not getting into progressive tax rates in this episode. So to calculate the tax due, you take 20% of $50,000. So the tax due equals $50,000 multiplied by 0.2, which equals 10,000. Now, let's say that you have $10,000 in tax deductions. Because a tax deduction reduces your taxable income, you subtract the $10,000 from your taxable income before you apply your tax rate. So if your taxable income is $50,000, less the $10,000 in deductions, you have an adjusted gross income. That just means your income less deductions, totaling $40,000. Then you apply the tax rate of 20%. So you take $40,000 multiplied by 0.2, and your tax due equals $8,000. So in this example, a deduction of $10,000 ultimately reduces your tax due by $2,000. It does not apply dollar for dollar to your tax due. Now that we have the general framework for a tax deduction, let's look at tax credits. Tax credits apply directly against and reduce the tax due. Using the same figures as above, we have taxable income of $50,000 and a tax rate of 20%. To calculate the tax due, you multiply $50,000 by 0.2, and your total tax due equals $10,000. Now let's assume you have a $10,000 tax credit. Because a tax credit reduces your tax due, you subtract the $10,000 from the tax due. So following the same calculation of 20% of $50,000 is $10,000, and then you take your tax due of $10,000 and subtract the $10,000 tax credit. So your tax due equals $10,000 less the $10,000 credit, which is zero. So a tax deduction applies to your taxable income. It reduces the amount of income that's subject to tax. So it has the effect of reducing your tax due, but not dollar for dollar. Instead, the deduction is subtracted from your total taxable income before your tax rate is applied to your taxable income. Whereas a tax credit applies directly against your bottom line tax due, reducing dollar for dollar the amount of tax that you will pay to the government. So if we're assuming the same figure in the form of a credit or a deduction, $10,000 in the form of a tax credit is going to have a much greater impact on the amount of tax that you pay to the government. This is the basic foundation that will help set us up to dive into the rest of this series on the charitable contribution, deduction. And just to make a couple of points, there aren't any above the line deductions currently, and there are no charitable contribution credits. So to give you a sneak peek into where we're going, in the next video, we're going to dive into the standard deduction and itemized deduction and take a look at how those two concepts affect the overall tax benefit of a charitable contribution. If you find this content useful, and if you're interested in tagging along for the rest of this series, please consider subscribing to the channel, and I'll hope to see you on the next episode.